Good morning, good afternoon, and good evening, wherever you're listening from. Welcome to the ACID Readers Briefing, the podcast that turns an entire issue of a major magazine into one focused, 20-minute audio package. Today, we are bringing you a reader's guide to the July 27th, 2026 issue of Barron's. So, what are the big ideas shaping this week's issue? The cover story focuses on the global building boom. Its world is filled with cranes, ports, factories, power grids, and heavy industrial equipment. But this story reaches far beyond construction sites. The central argument is that the investment boom is no longer limited to artificial intelligence data centers. A much broader global capital expenditure cycle has begun, driven by national security, energy resilience, the reshoring of manufacturing, and the reconfiguration of supply chains. 5 major questions run through the issue. First, federal debt and real interest rates have pushed up the price of long-term capital. So, how will the rising cost of funding constrain the supply of electricity, transmission networks, data centers, and the wider infrastructure needed to support artificial intelligence? Second, the global building boom has already moved beyond AI data centers. How will national security, energy resilience, manufacturing reshoring, and supply chain reconfiguration combine to create a multi-year capital expenditure cycle? Third, the artificial intelligence market has moved from pricing a vision to testing actual cash flow. Can chipmakers, cloud computing companies, power equipment suppliers, and other highly valued businesses prove that today's enormous spending will generate durable returns? Fourth, the Social Security Trust Fund could be depleted by 2032. How might annuities and medical device valuations reshape household retirement income, longevity risk, and healthcare spending? And fifth, when oil prices, bond yields, index dispersion, options volatility, and shareholder positions all shift at the same time, how will markets reassess risk, return, and corporate governance? Taken together, this issue presents a clear picture. Federal debt and real interest rates have increased the cost of long-term capital. Global manufacturing and infrastructure have entered a multi-year investment cycle. And the artificial intelligence market has moved beyond ambitious promises towards a much tougher test, whether all that spending can produce sustainable cash flow and lasting returns. With that larger picture in place, let us now move through today's issue, one article at a time.
Section 1. Macro, Fiscal Policy, and Long-Term Interest Rates. 1.1. This is the time when the federal debt actually matters. The article said that Japanese semiconductor companies gained their earlier advantage not because they possessed technology that American companies could not understand, but because they could obtain capital at a lower price. The present contest had shifted to the physical foundations required by artificial intelligence, including power generation, transmission, and data centers, all of which depended on long-term finance. The real yield on 10-year Treasury inflation-protected securities had risen above 2%, lifting an illustrated project cost from about 6% to about 8%, and increasing annual debt service on a 30-year asset by roughly 20%. With federal debt nearing $40 trillion, the government was competing with companies for long-term savings. The country's best place to lead the artificial intelligence economy would be those whose private sectors could finance long-term investment at the lowest cost of capital. 1.2. Sticky Inflation Indicator. The June inflation report did not show one clear downward direction. Slower consumer price inflation was driven mainly by cheaper gasoline, while producer prices cooled less and import price inflation strengthened again. The business inventory to sales ratio fell to 1.28 in May, its lowest level since November 2021, and its deviation from the 3-year trend was close to the largest in 5 years. Thin inventories, elevated upstream costs, and tight refined product supplies could turn the temporary pause created by older inventory into renewed pricing pressure during the next restocking cycle. The article therefore kept its estimate that consumer price inflation could remain close to 3.5% this year. 1.3. What the Fed got wrong and how it can fix it. Kevin Warsh created 5 working groups to study the inflation and labor market framework, communication strategy, balance sheet policy, and data sources. Economist Jai Kadia argued that the Federal Reserve should return to rule-based methods, use the Taylor rule to limit discretion, reduce forward guidance, and bring the balance sheet back toward its pre-2008 level over 10 years. In his view, rules did not guarantee perfect decisions, but they limited the range of error, protected central bank independence, and allowed unproven forecasts about artificial intelligence productivity to appear in actual data before they entered the interest rate formula. The Federal Reserve's job was to maintain price stability and maximum employment, not to rescue private companies. 1.4. Rising rates are a danger for markets. Treasury inflation-protected securities are a good bet. Real risk-free bond yields reached multi-year highs. The 10-year Treasury yielded 4.68%, while the corresponding Treasury inflation-protected security provided a real yield of 2.42%, implying break-even inflation of 2.26%. Higher real rates raised the financing cost of artificial intelligence and energy projects and reduced the present value of future earnings. Alphabet expected artificial intelligence capital expenditure of as much as $205 billion this year, and had already raised nearly $85 billion through stock and bond sales. For long-term investors, Treasury inflation-protected securities offered a direct real yield and inflation compensation. 1.5. Bearish omen for bonds. Liquidity waves in gold had typically led bond yields by about 20.5 months. The model suggested that yields could first move violently sideways and then rise again after mid-September. But the article stressed that the relationship could indicate direction and rhythm only, not an exact date or magnitude.
Section 2. Artificial Intelligence, Semiconductors, and Capital Expenditure. 2.1. Capital Expenditure Conundrum. The balance between artificial intelligence investment and return had become the central argument across the entire supply chain. Alphabet reported higher revenue and profit, yet its shares fell because of negative free cash flow and the absence of a long-term capital expenditure framework. General Electric Vernova faced similar questions about booking momentum. Expanding back 2.2. Artificial intelligence has rewritten the rules of the stock market. Artificial intelligence on and artificial intelligence off were replacing the older language of risk on and risk off. 5 of the 11 Standard & Poor's 500 sectors had shown zero or negative correlation with the index over the previous 5 months, and during the first 135 trading days of the year, the average stock moved opposite to the index on 52 days. Nvidia, Microsoft, Amazon, Alphabet, and Meta platforms represented about 1/4 of the index, while fewer than 14% of American adults used artificial intelligence at work every day. The market was therefore comparing corporate adoption, productivity, capital expenditure, and cash returns rather than rewarding vision alone. 2.3. A newly emboldened Advanced Micro Devices is taking direct aim at Nvidia. Advanced Micro Devices moved from being the second choice behind Nvidia toward becoming a direct competitor in artificial intelligence data centers. Its Helios rack combined graphics processors, central processors, and networking chips in one system, and the company said it was cheaper, faster, and more energy efficient than Nvidia's current server. Microsoft, Oracle, Meta Platforms, OpenAI, and Anthropic had begun deploying it. Management raised its 2030 artificial intelligence chip market estimate to $1.4 trillion. Nvidia still held a mature software ecosystem, however, and Helios still had to prove its advantage through delivery, software, and real operating performance. 2.4. Musk is losing his magic. Tesla is paying the price. Tesla reported second quarter operating profit of only $398 million, about $1.3 billion below Wall Street expectations, and the shares fell 14%. Investors were losing patience with hype followed by weak follow-through, while the valuation of roughly 175 times earnings still depended on autonomous driving, robots, energy, and software revenue arriving quickly. Musk now needed to prove the future again with actual results. 2.5. Earnings season is here. Will euphoric be good enough? Forecast second quarter earnings growth rose from 14% to about 25% and could finish near 28%, yet the Standard & Poor's 500 did not rise with it. Oil, bond yields, and artificial intelligence capital expenditure weighed on valuations. The article reminded younger investors that time was their scarce asset and that it was better used in low-cost index funds than by allowing artificial intelligence to trade on their behalf.
Section 3. Global Manufacturing, Trade, and Industrial Policy. 3.1. Beyond Artificial Intelligence, 10 Ways to Cash In on the Global Building Boom. Novartis began a 700,000 square foot manufacturing hub in North Carolina. Hanwha committed $5 billion to expand the Philadelphia shipyard, and India was building the world's largest renewable energy park in the Kutch Desert. The article said that 4 or 5 capital expenditure booms were unfolding at the same time as national security, energy resilience, tariffs, and supply chain reconfiguration turned spending from a policy idea into a necessity. American manufacturing capital expenditure was emerging from a 25-year decline and could gain an additional $10 trillion over the next 2 decades. The potential beneficiaries included Jacob Solutions, Martin Marietta Materials, Grupo Mexico, United Rentals, Will Scott Holdings, Rockwell Automation, and Korean defense, transformer, and nuclear equipment companies. Even if artificial intelligence investments slowed, national security, self-reliance, and infrastructure upgrades could sustain this multi-year industrial cycle. 3.2. Adam Smith helped create a wealthy America. Adam Smith and Thomas Jefferson both challenged the divine right of kings in 1776. Smith affirmed the right of individuals to transport, exchange, and trade, while Jefferson argued that a free people could reject a tyrant. The article also showed that Smith did not ask society to trust markets blindly. He warned about industry collusion, landlords, and inequality, and supported government protection of property, enforcement of contracts, and construction of roads, bridges, canals, and harbors. Hamilton later placed public works and tariffs inside American industrial policy. Free enterprise and public capacity together helped create American wealth. 3.3. Mexico stocks thrived despite the Trump rift. After the United States said it would not renew the United States-Mexico-Canada agreement, Mexican stocks were broadly flat, remained up 10% for the year, and the peso had gained more than 3%. Investors understood that even a failed review would leave the agreement in force for another 10 years, while two-way trade had reached $873 billion the previous year. Mexico could also benefit from graphics processor exports, more than $80 billion of planned data center investment, and industrial property demand. Yet strong state control of oil, gas, and electricity could restrict reliable power and private investment. So President Claudia Sheinbaum still needed to turn flexible diplomacy into domestic reform. 3.4. The first job for the United Kingdom's new Prime Minister. Andy Burnham became Britain's 5th Prime Minister since 2022 on July 20th. Reviving a stagnant economy was his first task, but after he proposed reducing homelessness, lowering taxes on energy bills, and cutting the bus fare cap, the 10-year government bond yield moved above 5%. The article argued that he first had to convince investors that the fiscal rules still held before he could pursue regional devolution and productivity reform. Liz Truss's 45-day premiership had already shown that policies without funding could quickly become higher borrowing costs, higher mortgage rates, and a political crisis. 3.5. The de minimis trade twist. The European Union ended the duty-free treatment of packages worth less than 150 euros and imposed a flat €3 tariff. Low-value parcels had risen from 1.3 billion to 5.9 billion in 3 years, with 91% coming from China. The rule narrowed the tax difference between cross-border platforms and local companies, but tariffs, customs processing, and logistics costs would also enter household prices.
Section 4. Healthcare, Insurance, and Retirement Security. 4.1. Prepare for possible Social Security cuts. If Congress did nothing, the Social Security Trust Fund supporting retirement benefits was projected to run out in 2032. Benefits would not disappear, but they would fall automatically. An average income couple aged 54 could lose as much as $194,500 over their lifetimes, while a high-income couple could lose $509,000. Raising the full retirement age would produce another form of reduction. The article advised families to plan between the two extremes of unchanged promises and no benefits at all, using additional savings to cover modeled gaps while recognizing that Congress could create long transition periods and protect people already close to retirement. 4.2. The 100 Best Annuities, How to Pick the Right One. Annuity sales reached $464 billion in 2025. The article advised buyers to decide first whether they wanted asset accumulation or lifetime income, and then compare several insurers, financial strength, fees, surrender periods, and protection structures. The highest payout was not automatically the right contract. When people bought an income rider but never turned on the income, a complicated product simply kept charging fees. For point 3, medical device stocks are on sale. The medical device exchange traded fund fell more than 20% during the year, while device makers traded at free cash flow yields of 5 to 6% and at valuation discounts of 20 to 30% to the Standard & Poor's 500. The article argued that artificial intelligence enthusiasm and worries about procedure volume had exaggerated the decline, and it examined recovery opportunities in Abbott Laboratories, Danaher, Intuitive Surgical, Medtronic, Boston Scientific, and Edwards Lifesciences. 4.4. Elevance Health Chief Executive buys stock after the post-earnings slide. Elevance Health beat quarterly forecasts, yet the shares fell more than 12% because investors did not see a clear recovery signal. Chief Executive Gail Boudreaux then used personal funds to buy 2,725 shares worth $1 million. An insider purchase could not remove medical cost and growth problems, but it showed that management was willing to accept more economic risk when the market had lost patience.
Section 5. Securities Market Structure, Income Instruments, and Trading Strategies. 5.1. Review and Preview, Markets, Companies, and Deals. An attack on Saudi tankers in the Red Sea pushed oil back to $100 a barrel. The 10-year Treasury yield reached its highest level in more than a year, and the Magnificent Seven lost $889.3 billion of market value in one day. The Dow Jones Industrial Average fell 0.38% for the week, the Standard & Poor's 500 fell 0.61%, and the Nasdaq Composite fell 13%. Roughly 160 Standard & Poor's 500 companies were due to report during the following week, while the Federal Open Market Committee would decide whether to raise rates. Headline and core personal consumption expenditure inflation were still expected to remain above the 2% target, so a modest slowdown would not remove policy pressure. 5.2. Oil is a portfolio's best friend. Energy was the cheapest sector in the Standard & Poor's 500 at only 13.8 times expected earnings for the next 12 months, and it offered a direct hedge against war and supply disruption. Over the previous 5 months, its correlation with the index had fallen to negative 0.4. The article argued that low valuation became a genuine margin of safety only when it was combined with asset quality, production costs, and capital discipline. 5.3. Trade options when others are fearful. The article argued that buying fear was usually better than selling because of fear. Investors could place limit orders in advance or sell put options on stocks they already wanted to own, collecting premiums to reduce the effective purchase price, but they had to be ready to accept the shares. More complex structures exchanged double downside exposure for upside participation, so unusual option activity and market panic could never replace fundamental judgment. 5.4. The age of free exchange-traded fund trades is ending. Fidelity imposed a 5% purchase fee, capped at $100, on investors buying exchange-traded funds whose managers refused to pay platform fees. The list expanded from 28 funds to 118, and Charles Schwab was preparing a similar system. Platform fees could compress the revenue of small funds, reduce liquidity, and bring costs back into trading. Investors, therefore, could not compare funds by the management fee alone.
5.5. Why bank stocks may beat real estate investment trusts for dividends. Real estate investment trusts offered higher average cash dividends than banks, but banks also provided buybacks and dividend increases. Financial sector earnings were expected to grow nearly 18% in the second quarter, compared with less than 6% for real estate, and total bank shareholder yield was close to 5%. The article preferred the current earnings trend in banks, while recognizing recession, loan losses, and changes in the yield curve as continuing risks. 5.6. Small cap strength. More than 1,200 stocks declined on Thursday. Yet the Russell Small Cap Index still outperformed large stocks, while industrials, healthcare, energy, and utilities were more resilient. The article said that internal buying support remained and that one day of selling had not destroyed the bull market, but the relative strength still had to be confirmed by broader market participation over time. 5.7. Winners and losers. UT's brands rose 95.6% in 1 week after a going private deal, while some NASDAQ stocks rose more than 200% or fell more than 50%. The table showed how mergers, earnings, and regulatory news could rapidly create extreme prices and volume, while the money capable of moving the main indexes remained concentrated in large technology and semiconductor companies. Extreme rankings could not replace fundamental analysis.
Section 6. Corporate events, shareholder activity, and high-volatility stocks. 6.1. If you like SpaceX, you are going to love this stock. Applied Aerospace and Defense supplied landing hardware for SpaceX's Falcon 9 rocket and was the sole source on more than 80% of its contracts. Sales were expected to grow 35%, and the backlog exceeded $1 billion. Analysts set an average target near $25, but the unlocking of a private equity stake, oil prices, and volatility across space stocks remained important risks. 6.2. Landing with a thud, SpaceX's weak start after its initial public offering. SpaceX fell 23% during its first 27 trading days and performed worse than 90% of American initial public offerings valued at $1 billion or more. Musk's shares were locked until June 2027, when about 60% of the company's shares would become eligible for sale. Index inclusion could create buying demand, but it could not remove lockup supply or long-term operating risk. 6.3. Disney's secret sauce. Kraft Heinz and Disney announced a strategic alliance covering food service, media, and events, with story-driven products intended to create memorable experiences. The article said that Disney could turn its enormous and loyal fan base into corporate partnership revenue, but the alliance would not solve all of the company's problems in cable television, film creativity, and theme park attendance.
6.4. Activist filings. 5 Schedule 13D. 5 Schedule 13D filings showed major restructuring stakes in Nassano Dimension, Metalla Royalty and Streaming, Xerox, Angel Oak, Mortgage Real Estate Investment Trust, and Daktronics. Beyond the numbers, the filings showed large shareholders increasing influence or using board settlements to rearrange corporate governance. 6.5. An Energizer stockholder powers up an 11% stake. Aqua Capital spent about $2 million to buy 100,000 Energizer shares and raised its stake to roughly 11%. The stock had fallen about 11% over the previous year. Yet second quarter operating earnings per share rose 40%, and the company gained market share from Duracell. The August 4 report would test whether margin and sales improvement could continue. 6.6. Mailbag and corrections. Readers wrote about Microsoft's backlog of more than $620 billion. Management responsibility at international business machines, professional athletes defrauded by a fake e-commerce platform, and the wealth transfer demand facing women financial advisors. A correction changed the year of the Philadelphia Eagles Super Bowl victory from 2026 to 2025.
All right, we are now ready to enter today's main program. Before we do, please like, save, and share this episode so that other people who need it can also see today's content and become better versions of themselves. Thank you. You can now use the timeline in the video description or the pinned comment to find the articles that interest you and listen to them in depth.